Hello, I'm called Jingonelli and I'm going to be taking you through topic 2 of accounting 2, that is partnership accounts. And before I begin, I would like you to subscribe and also follow what I'm pointing at, because I'm already having laid down information. So with partnership accounts, you get to look at partnership business. And with partnership business, what do they mean by partnership business? Partnership business is the relationship that exists between two or more people who come together to enter into business with an objective of earning and sharing profits. Then if you are to look at partnership is comprised of more than one person, and therefore the partners must agree upon the terms and conditions on which they will operate. So a partnership deed is established, and with a partnership deed is an agreement in which partners set out the terms and conditions of the partnership. So moving on, when it comes to the preparation of financial statements for the partnerships, with the financial statements normally prepared are the income statement and the balance sheet when it comes to partnerships. Now, these statements are similar to those of other businesses, except for the income statement, it has another component called the appropriation account, and this is the account in which partners share profits and losses in their profit and loss sharing ratios. Now, for the ratios, they will always be given in the question. Now, the account also records interest on drawings, interest on capital, and partners' salaries, if any. So, moving on to B, the balance sheet has both the current and capital accounts in the owner's equity section, as we are going to be seeing. Then they are saying the capital account records partners' contribution of capital to the partnership, while the current account records individual partners' dealings with the partnership. Then I would like to present to you the format of the income statement. Now, with this, you're going to be having the normal format of an income statement, having the sales, cost of sales, opening stock, I add your purchases, then you less the closing stock, which I've put in the my bracket, then you get the gross profit, which is this, then you add other incomes, then gross income, which is this, then you less your operating expenses, then you get your net profit or profit for the year. Now from here, it's where you add the appropriation account. Now you only add the interest on drawings, interest on capital, and partner's salary. If you are told you are being given if I told you I've given these terms to you in the question. So with this, what do they mean by interest on drawings? Now, when it comes to interest on drawings, it means that the partnership is gaining, in that if at all partner A and partner B are to withdraw drawings from the partnership, they will be charged with interest, meaning that A will pay some amount and B will pay some amount. So meaning that interest on drawings, it's supposed to be paid to the partnership. So you add it there on the net profit, you add it there. So meaning that whenever you're going to be faced with interest on drawings for partnerships, you're going to be adding it there on the profit for the year or the net profit. Then when you look at the interest on capital, with interest on capital, it's the partnership this time around which is giving interest to the partners for their capital contribution, meaning that if at all the partnership is giving out, you're going to less that amount it's giving out. That is partner A brought in this amount and partner B brought in some certain amount, and this is the interest they're going to be giving due to the capital they have contributed to the partnership. So that amount is always less. And then you move to the partner's salaries. With partner's salaries, if at all the partnership deed is indicating that partner B is to be given salary, that's when you're going to come and less the salary from the partnership, because again the partnership is to pay partner B. So meaning you're going to also less it. So you, after adding, lessing and lessing, then that's when you will get profits to be shared. Now with profits to be shared, this is the amount that has been left left at the end for the partners to share. So you can either get losses to be shared or profits to be shared. Now in this case, I'm assuming that you are having profits to be shared. This is just a format. Then if at all having the profits to be shared, then you go into the sharing, the profit sharing according to partner A and partner B. Like from this format, this partnership had only partner A and partner B, so the sharing will be among these two. So in the profit and loss sharing ratios, which will be given in the question, so after you are portioning A and B the profits which they got from the partnership, then that's when you state your last statement as profits shared, and this amount should be the same as this one. So this and this must be equal. So you, after knowing that, you go to the note. Here they're saying, note, interest on loan to the partnership is a business expense and therefore should be debited to the profit and loss. So whenever you're getting interest on loan to the partnership, it will mean it is a business expense and it will be debited to the profit and loss. And whenever you're debiting, it means an expense. Whenever you're debiting the profit and loss account, it means an expense. Then you're having the in case a partnership gives out a loan in return for interest, the interest received is treated as a miscellaneous income and should be added to the gross profit. So you, after knowing this, you'll be moving to the balance sheet. But as we are moving to the balance sheet, I would like to introduce in an element of partnership capital accounts. Now with partnership capital accounts, the capital accounts of the partnership are maintained either by a fixed capital balance method or a fluctuating balance method. Now with this, under the fixed capital balance method, the capital account records the partner's capital contribution only, and a current account is open to record the individual partners' dealings with the partnership. And then with under the fluctuating capital balance method, the capital account records both the individual partners' dealings with the partnership and their capital contribution. So for fluctuating, it's a combination, and for fixed, it separates the two accounts, that is the capital and the current. And for fluctuating, it adds them as one, or it combines them as one. So looking at its format of the fixed capital balance method, this is how it looks like. You're going to be having the capital account, whereby having the I'm still assuming from A and B as my partners. You're having your details A and B, details A and B. So the capital account will be having the balance brought forward. You know that capital is having a normal balance brought forward, which will be on the credit side. And if at all you're having additional capital still will be on the credit side, because it will be increasing the credit side of the capital account, and capital is increases by crediting. So if at all you bring in more capital, it will increase by crediting. And then the balancing figure, which will be the balance carried down, which will be this side, to make this side also balance. And this is what I have done, placing from that format. Then if I told them to look at the current account, remember I'm in the fixed capital balance method, which separates the two. With this, I'm going to say interest on capital, which is going to be on the credit side, because I know that interest on capital is going to increase my my current account, and salaries will also increase my current account, and also the share profits from the partnership will also increase my current account. And for all the things that will less my current account will be the drawings. If I told partner A or B, we removed some money from the business, which are the drawings, it will reduce the current account, meaning that if at all my current account is to reduce, it will reduce from the debit side, meaning that if at all I want to reduce the capital account, it will reduce by debiting, which I have done here. And if at all again I want to reduce it from the interest on drawings, because remember, interest on drawings, it's like they are paying for the amount they're paying for the amount of money they have withdrawn from the partnership. So from the partnership deed, basing on the agreement that you're supposed to pay interest on drawings, so this interest on drawing, they're going to also deduct it from the current account, and it's going to reduce the current account again. So meaning that interest on drawings, since it's reducing the current account, so I'm also going to debit it. So basically this is the format. So whenever having the drawings are going to be reducing the current account, and even interest on drawings, because you're paying for these drawings, it's more like an expense to the partners. So basing from that, that's when I look at 2. With 2, it's dealing with the fluctuating capital balance method. Now with the fluctuating capital balance method, it combines both what we had of the fixed of the capital and also the current. So meaning all this is going to be put the additional capital, the interest on capital, salaries, share profits, going to be put on the credit side, and this is going to be put on the debit side in the fluctuating, which combines them. That's why you're having additional capital, salaries, interest on capital, share profits, and then drawings, interest on drawings on the debit side, and this is on credit side. So the fluctuating capital balance method, it combines the capital and the current account. So after you knowing that, that's when I bring you to the final thing, the format of a balance sheet. Now with the balance sheet, it's the normal way of doing it. That's the non-current assets, the current assets, then you bring in the equity and liabilities. Now this is where the change comes in. For the equity, you're going to introduce in the capital account and the current account. That means here they used fixed, that's why you have separated them. But if at all you have used fluctuating, that means you're going to be having one account here, which will be the capital account, which will comprise of partner A and partner B. Now with this, when you look at the capital account, you will go back here. Since they are using fixed method, you will go back here. Now this balance carried down is going to be the one which will be brought here of A and B. Balance carried down of A of B is what's going to be brought here as this. Then if you have to look at the current account for A and B, balance carried down A and B, it's what you're going to bring here, meaning they use the fixed method. If at all they use the fluctuating method, it will mean that they're going to do one account, which is going to be the capital account, like SARS, and it won't be having the current account, and it would have worked out everything from here, and you'll get these two balances, which will just bring here of A and B, which will just use the two balances there. It's what you will bring here without this current. This current account would have been catered for here because this is a combination. So you, after knowing that you continue with your non-current assets, the current liabilities, and then you'll be done. And you'll be done with partnership balance sheet, and from there you can attempt any question concerning that. Thank you for watching. Make sure you subscribe.